So, what determines a state's ability to service its debt? Well, the same thing that determines if a private household is able to service its debt: its income and its expenditures. So, in case of a state, its income is the taxes and fees it levies, which have to be paid by all actors in the economy. Its expenditures, on the other hand, are very diverse. It has to pay interest on its current debt, and salaries to government agents, like politicians, police, and so on. It also pays pensions to retirees, and funds all kinds of other programs. This is not too dissimilar to a typical private household, which usually only has a few large income streams that are used to cover a wide variety of expenses. But the similarities break down when looking at the government's ability to change its income and expenditure. A private household can increase its creditworthiness by increasing its income, perhaps by working overtime or taking on a second job, and at the same time decreasing its expenses by cutting back on its standard of living. While this is probably quite unpleasant, it is usually possible. Generally, the same thing does not hold true for governments. Since any economy can only bear a certain level of taxation, a state's income is usually, more or less, proportional to the size of its economy. If a government were to raise taxes beyond this theoretical optimal point, it would start to strangle its economy, thus shrinking it, therefore decreasing taxable activity, and hence reducing total tax revenue. So it is usually quite hard to increase income by raising taxes. On the other hand, much of the expenses of a government typically find their way into the economy, and thus increase GDP, and therefore the tax basis. GDP stands for Gross Domestic Product. It measures the size of an economy by adding up the market price of all goods and services produced in a country in a year. So, if a government reduces benefits or cuts back on some programs or lays off civil servants, it typically hurts its GDP, at least in the short term, because people then have less money to spend and therefore the state receives fewer taxes. Also, if the economy starts to contract, more people get laid off, and thus expenses for unemployment benefits and such start to rise. Another obstacle to cutting spending, which might seem superficial, but is probably the hardest to overcome in reality, is that it is very unpopular, and thus politically difficult. Reducing spending means paying less to some group, and of course that group is not gonna be happy about that. So, in a sense, the only option a government has to reduce its deficit is increasing its income by growing its economy. With all that in mind, we can now give a partial answer to the second question. Perpetual economic growth is so important because it is the government's only option to increase its income, which it in turn needs to fund its ever-growing debt. If a state's economy stops growing, its income will stagnate, and therefore, every year a larger part of its budget will go towards servicing the interest on the debt, until sooner or later the state's ability to service its debt will be thrown into question, and then the previously discussed vicious cycle finally forces the country into bankruptcy. But not just any kind of economic growth is enough, it has to be exponential growth. After all, debt grows exponentially, and since interest is some percentage of the debt, interest grows exponentially as well. But as the economist Kenneth E. Boulding said, anyone who believes exponential growth can go on forever in a finite world is either a madman or an economist. So the entire economic system is flawed by design. But, as mentioned, this answer is only partially complete. It ignores, among other things, the fact that economic growth is not just important to the government, but actually to any debtor. As we previously observed, repaying a loan with interest is realistically only possible if someone else takes out a new, bigger loan and spends it into the economy, so that the first debtor can earn not only the principal of his debt, but also the interest. But such loans are only taken out if there is the possibility of further economic expansion. If entrepreneurs and companies see no point in further expanding their businesses, and no new loans are taken out, debtors find themselves unable to repay their loans and have to default. This is a very short description of a deflationary collapse. It is deflationary because the money is drained from the system as loans are being repaid, reducing the money supply, while increasing the demand for money, making money more valuable, and therefore everything else, measured in money, less valuable as a result. So how did the economy behave compared to the debt in the last years and decades? This chart shows the public debt to GDP ratio of the United States. Clearly, GDP growth could not keep up with public debt growth since 1980, and only recently a ratio of 1:1 was reached. This picture of debt growing faster than GDP is the same for pretty much all major industrial countries in the world. The average debt to GDP ratio in Europe is above 80%, even though the Growth and Stability Pact decrees that only 60% shall be tolerated. But the most severe example in this respect is Japan, which has a debt in excess of 230% of its GDP. Keep in mind that a government's income does not equal its GDP, but is rather only a fraction of it. For example, in 2011, US public debt stood below $15 trillion, while government income was a little above $2 trillion. This means the government's debt stands at more than 7 times its yearly income, before any expenses. Based on the cost forecast for the unfunded liabilities, why is anybody willing to lend any money to the government? Surely there is something wrong with the answer to the second question. And in fact there is, because it is actually only true if the state or government in question does not control its own currency, like Greece with the euro, for example. For countries like the United States or Japan, which control their own currency and therefore the interest rates, there is another option, and it is in fact the way Japan kept itself more or less afloat the last 20 years. And it is also the path the US and most of the rest of the world tries to walk. And that is lowering interest rates and devaluing the currency. We already know that the central bank of a country can lower the primary interest rate by increasing the money supply, thus lowering all interest rates. This provides several benefits, if perhaps only in the short term. With loans becoming cheaper, bond yields, which are just another form of loan or debt, go down. So investors that were previously happy with the returns they made on their bonds now have to switch to riskier asset classes, typically stocks. And the rising stock market often sparks optimism in the future development of the economy. It also increases the value of current bonds that still provide a higher yield. But the main effect is the increase in actual economic activity. When discussing the concept of an elastic money supply, we saw that lower interest rates led to more projects being implemented, even if some of them were perhaps of dubious quality. At the same time, lower interest rates also entice additional consumer spending, which leads to higher demand. Also, the government can finance any deficit spending more cheaply, making fiscal stimulus more affordable. Further, corporations have to pay less interest on their debt, increasing their profits and enticing additional investments. Another dynamic that I will explain more closely in a future video is that lowering interest rates leads to a cheaper currency, making domestically produced goods cheaper to foreigners, and thus also increasing foreign demand. So all those things promote economic growth, at least in the short term. But there is no free lunch. Lower interest rates often lead to bubbles, as was the case in the US and Spain with their housing bubbles, both arguably caused by low interest rates. Through cheaper rates, people found themselves able to pay mortgages that were previously too expensive for them. So, through the added demand, house prices started to rise. But with continuously rising prices, even more people wanted their piece of the action. Since nobody ever had to default on their mortgage as long as the price of their property kept rising, the whole mortgage business seemed very safe and practically risk-free. So banks lowered lending standards, reducing the required amount for down payments, and did not vet the borrower's ability to actually repay the mortgage that they were signing. After all, they bought houses that kept rising in value, and if their borrowers were unable to pay, they could simply sell the house and still turn a profit. Or so they thought. Of course it had to end badly. But housing is just one example. Any additional projects that are implemented only because debt got cheaper might turn out to be malinvestments, and therefore actually a waste of money. And of course, people living off of fixed income, like pensioners, are being hurt by lower rates, because their income decreases proportionally. Probably the most problematic issue is the addiction to ever-decreasing interest rates, though. Since lower interest rates entice additional debt growth, it is very hard to raise interest rates in the future, unless the economy grows even more rapidly. Otherwise, the interest on the accumulated debt takes an even bigger portion of the income than before. Japan, for example, with its debt to GDP ratio of 230%, spends about 1/3 of its total income on interest payments for its massive debt, and debt with interest rates at only 1%. A rise of only 2 percentage points to 3% would bankrupt the country, because then their entire income would go exclusively towards servicing the debt. So they cannot allow their interest rates to rise at all. And finally, the flip side of additional demand through cheap and plentiful money is the problem of inflation. So if a state is in control of its own money supply through its own central bank, it can stimulate additional GDP growth and decrease its interest burden by lowering interest rates. Let's have a look at how far the US has come in this regard. As US public debt, represented by the red line, kept rising over the last 30 years, the federal funds rate, as shown by the blue line, has kept trending lower until it reached 0% in 2008, where it has remained ever since. And it is set to remain there until at least 2014, based on statements made by the FOMC, the Federal Open Market Committee, i.e. the board of directors of the Fed. But unless growth returns, and in a big way too, we already know that it is pretty much impossible for the Fed to raise interest rates again in any meaningful way, without bankrupting the state in the process. Again, I was using the US as an example here, but the interest rate and public debt picture in Europe is very similar, and actually much worse in Japan. But even if the central bank lowers interest rates to zero, the interest one has to pay on a loan is not simply a function of the average interest level, but of course is also influenced by other factors, such as the risk of default of the debtor or the expectation of future inflation. So even if the interest level stays depressed in general, there is no immediate reason for government interest rates to stay low specifically. We already looked at the size of the government's debt, first in absolute terms and then relative to GDP. But to really get an understanding of the government's creditworthiness, one has to look at its income vis-à-vis its actual expenditures. To make those numbers a little easier to grasp, let's also look at what such levels of spending and debt would mean for the average American household. So in the fiscal year of 2011, enacted federal government revenue was about $2.3 trillion, which translates into the median household income of approximately $50,000. Enacted federal spending, on the other hand, was $3.6 trillion. For our household, this would mean expenditures of $77,000 per year, a deficit of 27 grand. So the government does not only have to issue bonds to roll over its old debt, it also has to issue new bonds on top to pay for the newly accrued deficit. Likewise, in 2010, the government also had a deficit of about $1.3 trillion, or another 28K for our hypothetical household. In 2009, the fiscal year of the financial crisis, the deficit was even bigger, reaching $1.4 trillion, which translate into 31K. But even when times were supposedly good, in the fiscal year of 2008, the US government had a deficit of about 1/5 of its income. In total, all budget deficits and surpluses in US history add up to a grand total of $15.7 trillion of debt. In household terms, that would mean a debt of $341,000, which in 2011, even with historically low interest rates, caused an interest payment of approximately $450 billion, or 20% of federal government income. Now, imagine you had a friend who constantly needed to borrow money because he kept spending more than he made, year after year. Imagine that the interest spending alone took 1/5 of his income, even though he pays historically low interest rates. Imagine his debt was already at $341,000, and it did not even include all kinds of promises and guarantees he made, which are estimated to be multiples of his current debt. Would you lend your money to this friend, especially for such low returns? Now, of course, this comparison, like most analogies, is flawed in various ways. For example, even if your friend is able to secure a higher income every year to handle his growing obligations, his eventual death would cause his creditors enormous losses, so they would not be willing to let him go ever deeper into debt. The government, on the other hand, has no foreseeable expiration date. But the underlying truth remains. The US government, and actually most governments around the world, are indebted way over their heads and running large deficits, and markets will sooner or later call their ability to roll over and service their debts into question. But even if investors lose confidence and start demanding higher interest rates, some governments that control their own currency have yet another option. They can influence their central bank to buy their bonds with newly created money, thus creating additional demand and keeping rates depressed ad infinitum. This is called monetizing the debt, because the debt is being paid by newly created base money, and this is in fact what the Fed did through its quantitative easing programs, QE in short. In fact, in 2011, 61% of all government debt was bought by the Fed. But this has its own problems, of course. As Alan Greenspan, former chairman of the Federal Reserve, said in 2005, "We can guarantee cash benefits as far out and at whatever size you like, but we cannot guarantee their purchasing power." We will revisit this statement in the future, but for now we wrap up by reviewing the most important observations and conclusions we have drawn.